Great. Well, welcome to session two. My name is Garrick Heilman. It's a pleasure to be back on the Web3 course here, teaching this week Bitcoin, how it works, and hoping we can have a lively discussion with lots of good questions, comments. Happy to talk about price. Happy to talk about how I finally I got the we're with yeah, important disclaimer, of course, right up front. I guess we should mention this right now. Um, Nothing, of course, that we discuss today should be considered investment advice. You should do your own research. Any information or thoughts provided by myself or the University of Nicosia is strictly for informational purposes, of course. But we obviously can talk about the market dynamics, market structure, and why I am not surprised we're seeing some of the price action we're seeing in the market today. I actually was on social media last year, I think, with a well-timed call regarding this. So you can check out what I had to say on my X Twitter profile if you want on kind of what was happening with Bitcoin market structure and pricing dynamics last year, and may help you understand where we are at the moment. So, but today we're going to, of course, focus a lot of the discussion on how Bitcoin works and kind of more the mechanics and whatnot. Um, and yeah, so let's actually go. I'm just going to pull up, I think, the questions I should have in my email here. Let me get those in front of me. Pull these up on a. Okay. Okay, we've got those. Um, Great. So yeah, I think, we should probably briefly just kind of talk a bit about a few basic concepts. I know Bitcoin is, the most well-known, the largest, the oldest of the major crypto assets. Um, we have, I think, started to change, how we describe Bitcoin. And even in, this presentation here, you'll see the term currency used. But I think that kind of is where I'd like to start, and why referring to Bitcoin as a currency oftentimes creates a lot of misunderstandings and problems about what it really is, what it's used for, and what its strengths and weaknesses are. So when Bitcoin was first introduced to the world 18 years ago, this year it will be now. It's incredible. We're coming up on 2 decades since Satoshi Nakamoto uh, published the Bitcoin white paper on Halloween 2008, just a few weeks after the collapse of Lehman Brothers and the start of the great financial crisis. It was known as a cryptocurrency. Um, some regulators would call it a virtual currency or a digital currency, but the term currency was very commonly associated with Bitcoin in those early years. My first paper that even discussed Bitcoin was comparing it to alternative currencies, so non-state backed, non-state issued currencies, tokens, et cetera, which have existed for hundreds of years before Bitcoin was invented. I looked at the history of alternative currencies to try to understand what history might have to say about Bitcoin's prospects as a currency. But at some point, 2015, 2016, maybe a bit later than that, we started to hear the term crypto asset introduced more. And this was done in part because we were learning through survey data carried out by private organizations as well as by central banks and other public sector entities that people didn't really want to spend their Bitcoin as much as they wanted to invest in it. And it started to be seen and regulated in some major jurisdictions like the United States as a commodity. It's true that in the early years, FinCEN here in the U.S., part of the Treasury Department, was looking at it from a money transmission perspective and wanting firms to register if they were going to be engaged in handling Bitcoin. But as it turns out, and some I think were early to spot this, digital gold is what Bitcoin has kind of become best known as. It's become known as a scarce, hard digital asset with a finite supply, which makes it relatively unique, to my knowledge, in the history of kind of investable assets. Gold, actual gold, physical gold, in theory, has an unlimited supply. And as we see when the price goes up, people dig deeper for more gold, right? You can justify spending more resources, more money to try to get at gold as the price goes up. Whereas Bitcoin's supply does not change no matter what's happening with price by and large. It's true that at a micro level, you'll see an acceleration of Bitcoin mining, which can accelerate the speed at which Bitcoins come into new Bitcoins are mined into existence. But the total supply of 21 million actually stays fixed regardless of what's happening with its price, and that's unique among commodities. But I just wanted to highlight this kind of jargon terminology confusion right off the bat. Many prefer the term crypto asset to cryptocurrency today. And in fact, I was actually recently testifying as a court-appointed expert in Dubai just a couple weeks ago on this actual question: Is Bitcoin money? Is it a currency? Or if it isn't, what is it? And that designation has legal ramifications for court settlement issues, and that's a whole nother topic we could discuss. Looking forward to seeing the results of that uh, court case here in a few months. But yeah, I just want to highlight right off the bat that the term crypto asset is my preferred term, even though, yes, it's true, we do see Bitcoin used on occasion as a currency. You can buy things with it. It's not always very easy. There aren't always very many online or in-person merchants where it can be exchanged. We do see people, of course, transferring Bitcoin across borders or even within borders to pay a dinner tab or even earn a wage in Bitcoin. There are ways to do that, particularly if you work in the crypto industry. A lot of crypto companies let you uh, earn your salary in Bitcoin. Um, so so that's just a quick comment there about what to call Bitcoin. And I'm actually curious, Andreas, I'd like to do a poll if we could right now. Um, I know I kind of made the hard sales pitch there for calling Bitcoin a crypto asset versus a cryptocurrency, but I'm curious what you think and whether you agree with that. Or do you think cryptocurrency is a more appropriate term to describe what Bitcoin is, or something else completely different? Should we call it a digital commodity, a digital asset, and not a crypto asset or a cryptocurrency? So, Andres, could we run a quick poll asking the students if they prefer the term cryptocurrency as the first selection for Bitcoin, crypto asset as a second, or something else?
Yep, doing it right now.
That's great. While you're doing that, I'm going to actually also, I want to just quickly pivot to a brief overview of money that I always like to get into as well when covering the topic of Bitcoin, and it's relevant to what we were just discussing.
So you should be able to see it on your screen.
That's perfect. Thank
Yep,
you.
perfect.
Just give a few moments to the class to. I'm not allowed to vote, so I think I already sufficiently biased you, which is not what you're supposed to do when you're doing a poll. But yeah, I love disagreement, and I'd love to hear strong arguments for something other than what I've proposed. These sessions are a chance for me to learn from you as well. Are we
Right now, 80% of participants have, well, participated.
perfect? Yeah,
Yeah,
let's go ahead and close it off.
sure. Yeah. And I'll share the results. Yeah.
Good. So there's a pretty significant number that yeah, like the term cryptocurrency. The crypto asset category is the got the most votes, but there's also, uh, a non-zero number who think something else um, is worth. Does someone want to speak or say something about why they believe cryptocurrency, despite my arguments, is the better term or preferred term? And then I'd love to hear from someone also who suggested other about why what other term they think is appropriate, or if you want to put it in the comments, that's great as well. Yeah. Alice makes an interesting point. Since it is crypto, I tend to reject the term digital asset. Digital is too broad in this context. I think that's actually, it's funny. This actually came up in this court case um, where there was discussion of Bitcoin as a currency in the digital economy, which in my mind, and perhaps Alice, I think it sounds like Neil, you might agree with this. Digital economy could be a lot more than just crypto. It could include the whole world of e-commerce and uh, non-crypto related digital kind of activities. And that's a much bigger world, arguably, if you include within the digital economy crypto, right? This digital economy is significantly larger than just crypto. And Bitcoin's not accepted on sites like Amazon.com, for example, or I don't think any of the Chinese sites where it's still kind of frowned upon or actively policed against use for Alibaba and these types of things. But yeah, that's I think an interesting point that I would agree with. You could maybe think of crypto as something within the world of digital assets, right? In a similar way, but um, not representing the entirety of digital assets. Yes, a peer-to-peer cash system, right? The original title in the Bitcoin white paper that Satoshi gave certainly suggested a more payments-focused use and currency use. And really in the early days too, we're going to talk a little bit about Bitcoin history here in just a moment before we get to our discussion of what is money. You did see on a percentage basis, I think crypto used more as a currency in those early years on, some of the early online gambling and gaming sites, Satoshi Dice and so on, as well as, of course, infamously on the Silk Road dark web marketplace. It was over time that we saw a shift in the user base of Bitcoin and survey data suggesting that the vast majority of people are investing in Bitcoin. They're not using it to buy things online or go and get their cup of coffee and pay for it with Bitcoin. Um, I'm just scrolling through the comments here. Thank you for all these comments and thoughts here. Yeah, so Bitcoin's Wacom, I think, makes a good point. So a lot of people see Bitcoin as an alternative to fiat currency, as kind of an escape hatch for the decline of the almighty US dollar. Breaks my heart as an American to see our dollar discussed in such fatalistic terms. But with that thought, yes, I think Joaquin makes a great point that when you're talking about Bitcoin in that context, imagining it as something that could compete with or even maybe supplant one day the US dollar as a global currency, as global money, is certainly something that warrants, perhaps and justifies the use of the term cryptocurrency for this imagined possibility, right? Not the world today. The dollar is still king, for now at least. But when you imagine that future, you might think cryptocurrency could be appropriate. Um, yeah, Jesse, you don't see it as a real currency as long as it's not mainstream. Good thoughts. Uh, I prefer to call it God, Costa says. Um, Interesting. That's a new one. In my decade plus of teaching, I haven't seen that. So thank you for sharing that. Yeah, it can be used as store of value, also meme exchange, et cetera, et cetera. Okay, we're going to talk more about these different functions that economists use to kind of define what is money. But first, before we do that, I just want to quickly go through a little cryptocurrency history. We talked about Satoshi, the inventor. There's some people, though, who came before Satoshi who play a pivotal role in this whole story of Bitcoin. And I just want to give you a little further context. Um, these are this early history along with kind of a quick discussion of what is money is really where I start my lectures on Bitcoin, and I think it's incredibly important to cover this. So where does the story of Bitcoin begin? Where does this journey unfold first? And it really begins with a group called the Cypherpunks. The Cypherpunks were a group that came together in the 1980s, 1990s. Many of them were here in the San Francisco Bay Area, where I am. Uh, but not just here. You can see Julian Assange's photo somewhere here on the wall there. He was a cypherpunk, an Australian. So it was a global community. Sometimes these folks would get together in real life. And the cypherpunks cared very deeply about privacy. In fact, in 1993, they penned their cypherpunk manifesto. This is just a brief snippet from the opening of that one-page manifesto, but I'll read this just to give you a little flavor of their philosophy. And think back, this is really before the internet even took off, right? In 1993, privacy is necessary for an open society in the electronic age. Privacy is not secrecy. A private matter is something one doesn't want the whole world to know, but a secret matter is something one doesn't want anybody to know. Privacy is the power to selectively reveal oneself to the world. So right off the bat, they're making a very nuanced, kind of case for distinguishing between secrecy and privacy, and how privacy is an important element of freedom. And they really were ahead of their times, right? I mean, like I said, they started coming together in the 80s and 90s, early 90s, before the internet was really a thing in mainstream circles. And they saw really the future of this electronic age, and how the surveillance economy and whatnot could really damage freedom and open discourse and so on and so forth. So a lot of the cypherpunks were concerned about communication privacy and developing encryption tools to protect communication privacy, but they also many of them were interested in financial privacy. And I mean, one of the most striking things about this whole cypherpunk phenomenon is that this actually goes all the way back to the early 1980s. The story of cryptocurrency does, at least, with David Chaum when he was, I believe, a grad student at UC Berkeley in 1982, writing a paper on anonymous electronic money. Chaum, I believe, is still alive. I actually met him at the decentralized conference that University of Nicosia helped organize pre-pandemic. He came out and spoke in Athens. That was a real pleasure to meet the legend, arguably the father of cryptocurrency. But he's writing and developing concepts around anonymous electronic money all the way back, 44 years ago. I mean, that's just incredible, right? Long before the 2008 Bitcoin white paper comes out. And in fact, many attempts at cryptocurrency were launched in the subsequent years, including Chaum's DigiCash in 1998. And if you read Wired magazine articles written about DigiCash from that time frame, they actually resemble some of the early articles written about Bitcoin. You could actually substitute the Bitcoin word into the article, and it would sound a lot like a 2011 or 12, 13 Bitcoin story. There are big differences between DigiCash and Bitcoin, but many of these ideas were not totally new. And crucially, all the technical pieces that were necessary for Bitcoin to exist had actually been invented over a decade before Satoshi releases the white paper in 2008. Adam Back's proof of work, distributed timestamp ledgers, networking protocols, the cryptography, all of that was around for over a decade. You can think of it as sitting on the shelf for Satoshi just to kind of take off the shelf and kind of fasten together into this thing called Bitcoin. The thing that had held up the invention of Bitcoin was coming up with a decentralized solution to the double spending problem, or the Byzantine's generals problem, which the slides that you hopefully had a chance to review before today cover. Kind of analog way to imagine this double spending problem is the old vending machine trick where you tie a coin to a string that you can then endlessly reinsert to get an endless supply of Coca-Cola without spending any money, using the same currency for multiple transactions, right? That's a good way to quickly devalue, debauch any thing designed to be used for payments or store value if it can be replicated, double spent, and so on. And the cypherpunks couldn't figure out pre-Satoshi how to create a decentralized solution to this double spending problem without some kind of centralized entity like a bank, in essence, maintaining a master ledger of who owns what and who had spent what. Well, then along comes Satoshi's now famous white paper, eloquently describing how you could marry basically proof of work with a publicly accessible distributed timestamp ledger, which we now call the blockchain, to solve this double spending problem to maintain reliable digital scarcity on the internet. That's the big innovation that Satoshi brought. This was not relying on anything centralized like some of the other cryptocurrency efforts had, and could be therefore relatively decentralized. Just real quick, high level, simple way to think about what a blockchain network like Bitcoin, how it is similar and different from our traditional financial system. You can think of our financial world as having two main elements: the forms of value, the assets, the currencies like US dollars, stocks, bonds, et cetera, on the one hand, and then you've got the networks and ledgers on which they travel and move. And you can think of those assets or currencies as train cars traveling on train tracks, right? And what I like to say is, you can pick up your US dollars, right, this train car, and you can move it to a different set of train tracks. It can move, via Visa's rails, or it can move on PayPal's rails, or Fedwire, or using the Swift messaging system even to kind of coordinate transfer. The train, the dollars are not locked to any track, so to speak. But that's not true with Bitcoin. Bitcoin is an integrated system, and the Bitcoin only live on the blockchain, right? You can have atomic versions, wrapped versions of Bitcoin, but the native digital Bitcoin exists solely on the blockchain, the blockchain train tracks, right? And that way, it's an integrated system. It has limitations, of course, because of that integration, but there's benefits in terms of security and programmability that you gain through that really tight integration that our traditional financial system lacks. Okay, so that's a brief kind of just history of Bitcoin, and kind of one way to contrast it with what came before, both in the traditional financial services world and the crypto world that predates Bitcoin by 40 or 30, 35 years, I guess, going back to Chom's paper. Is that right? 20, 25 years, 25 years, something like that. Okay. Let's talk briefly, though, about money and currency. This is so important. I think if any of you are out teaching Bitcoin to others, you're around the holiday table with parents, grandparents, siblings. The first place to start is not blockchain and crypto asset versus cryptocurrency and 21 million and proof of work and all the jargon. It's actually to start with money and help people understand this topic. In my 15 plus years of teaching this subject now, it's still stunning to me every time I get into what is money and where does it come from, how little, not just the general public, the man and the woman in the street, so to speak, know about that question, but also even people in financial companies. I do a lot of executive education teaching, and it's been surprising to me when I've been working with certain divisions of banks, even how not well understood money is. But it really shouldn't be that surprising because this is not something that's even often taught, what we're going to cover right now in economics 101 classes or certainly in secondary, high school level education even. And that's pretty striking, right? This institution money, which almost everyone on planet Earth has to use, um, is not really explained kind of from the ground up in terms of where it comes from and how it's manufactured into existence, so to speak. So that's really the first place to begin any discussion of Bitcoin is what is money and where does it come from? So let me ask you, and you can just respond. Oh, I accidentally skipped ahead with the answer to the question. I was going to ask, where does money come from? It doesn't grow on trees anymore. In places like the UK, it's now plastic. It's not paper even. Um, but the answer many people give is, well, it comes from the mint. The stuff we can touch, the notes, the coins in our pocket is coming from a central bank or the government mint, and that's true. But that's a tiny percentage of the money supply. The oftentimes less than 10%, maybe as low as 2 or 1% even of the total money supply are coins and notes, the things that are tangible we can touch. The 90% or more of our money supply actually comes from banks, and they create money through the process of making loans. So when you go get a mortgage for buying a property or a car loan, the bank will lend new money into existence. All right, that's the magic superpower of a bank. It has the power to create new money through the process of loans. That's where most of our money comes from, not from the government. And this is not something that the man and the woman in the street knows. You now know something that most people do not know, that it's private sector for-profit institutions. In most countries, that's what banks are, heavily regulated, but they're for-profit private sector institutions that create our money. And when you realize that, you say, well, wait a minute, Bitcoin was created not by a government so far as we know. There's rumors about the CIA or NSA being involved, right? But putting that aside, a private sector individual came up with a 21 million coin limit and protocol and released that. That's a private, potentially for profit. I know Satoshi hasn't moved any coins supposedly. Um, but there's that similarity, right, between our current money system, which is bank led, bank money creation led, and crypto private sector creation led, right? So, how far fetched is it to imagine a world where cryptocurrency could take on maybe more monetary functions, right? But the key thing here is, yeah, you now understand something about where money comes from that the vast majority of people do not. And that's really helpful for understanding, why Bitcoin exists, what it has to offer potentially versus the traditional financial system. Okay. Um, Henry Ford, over a century ago, said this about the money system. It's well enough that the people of the nation do not know or understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. This is back during the Great Depression, I believe, when he made this famous quote, the inventor of the assembly line and modern manufacturing, Ford Motor Company. Um, I've actually talked with people at central banks and multilateral institutions who don't want they think it's better if the general public does not know, per Henry Ford's comment here about how the monetary system works. They think it actually would be too disruptive if this is widely known. So perhaps that's why this is not taught, not just in economics 101, but even in secondary education. I think that's a great problem and a real um, you know foundational issue to the financial literacy crisis we have across the world today. We have a digital divide. We also have a financial literacy challenge that is massive, and it starts here with understanding where money comes from. Okay, so this leads us to the last thing I want to say about um, the economics of traditional money, and gets into this question of whether Bitcoin is money. This is, as I mentioned, the very question I was testifying as a court expert on a few weeks ago. Um, there are three functions that economists typically cite when trying to answer the question of whether or not something meets or passes the test of being money. And these three functional characteristics are: is it a medium of exchange? Are you seeing it used widely to transact for goods and services, to help avoid the barter problem where you need to have two goods that are perfectly comparable and can be exchanged at a given point in time? Money allows you to get away from barter, to have something that you can buy goods and services with. Um, and that's one of the primary, I think, functional characteristics of money. Second is that's a store of value. It can be saved, from one day to the next, it has some value. Now, interestingly, economists don't really get into this question of how stable that store of value should be. Um, but one can, make some arguments and imagine that something that's wildly fluctuating might have a hard time forming a store value function from a monetary perspective, as well as something that is more stable, right? It can be hard to plan, um, make your rent payment at the end of the month if the thing you're trying to make that payment with is fluctuating wildly in value. But we can put that aside for a second. And then the third, and I think least well understood characteristic of money, is that it's a unit of account. It's what goods and services are priced in. Things are divisible in this unit. Um, Companies, may keep their books, their accounting records in this unit, right? That's what a unit of account um, functional test represents. And another way of looking at these three functional characteristics of money is you can visualize them in in kind of a hierarchical kind of concentric circle view, where in our world today there are many, many things that are stores of value besides money, right? You can think of art, you can think of stocks, bonds, real estate, gold, commodities, etc. That's really the biggest bucket of these three different functions of money. We also see more than just, of course, um, fiat currency used as a medium exchange. Bitcoin, as we discussed, is used to buy things. Sometimes on illicit marketplaces, but sometimes in legitimate transactions. People will pay for things, alpaca socks, pizzas, etc., with Bitcoin, right? So there are fewer maybe medium of exchanges out there than stores of value, but there are ones besides fiat currency. But the last and maybe most exclusive function of money, the unit of account function, this is where you I think have a harder time finding examples of Bitcoin or any cryptocurrency serving as a true unit of account. You know, and I'll kind of highlight this with a story I like to tell from my time at the University of Cambridge. When I got to Cambridge, I looked on the Bitcoin business map and saw there were some businesses that accepted Bitcoin in Cambridge. And I found a pub that actually accepted Bitcoin. So I went into this pub. Internet service was terrible, but I said I wanted to pay for my Sunday chicken roast meal with Bitcoin. And the man working at the pub kind of groaned, and he had to haul out this like special machine he had, which was fiddly. And like I said, the internet connection out there is not great. But I did manage to pay for my Sunday chicken meal with Bitcoin. Um, but the question, kind of the thought experiment I ask you to think about as we think about, was Bitcoin really serving as a unit of account at this pub, is imagine the following week I go back and Bitcoin has dropped 50% in value against the pound and the dollar and other fiat currencies, as it did as recently as March 2020, right? It lost 50% in a single day. It's lost 40 to 50% in the last 4 or 5 months. But it can lose that amount even in a single day. It did that also back in December 2013. So just hypothetically, imagine I go back into the pub, want to buy the same chicken Sunday roast meal with Bitcoin. How many Bitcoins am I going to be spending for that same meal a week later? Um, and would it be the same number of Bitcoins because I'm buying the same thing? Or is it going to be a different number? Any thoughts or comments? Well, I'll answer the question. The number of Bitcoin is going to be double what I paid the week before with Bitcoin's price. Exactly, it's a different number. I'm not, even though I'm buying the same chicken lunch, I'm gonna have to spend twice as many Bitcoin because the price of Bitcoin dropped against fiat currency by 50%. So what that tells you is that even though the pub is quoting a Bitcoin price for a good, a chicken Sunday roast meal, it's not really using Bitcoin as its unit of account. As the price of Bitcoin fluctuates against that of the pound in the Cambridge pub, the number of Bitcoin that I would have to exchange or provide to purchase the chicken meal is going to fluctuate as well. In other words, the true unit of account at the pub is the British pound, not Bitcoin. They're just offering basically a a way to convert your Bitcoin, which is usually managed by a Bitcoin payment processor like Coinbase or BitPay, where the pub doesn't even take possession of the Bitcoin, instead gets pounds because that's what they keep their accounting records in and what their banks will accept for deposit and so on and so forth. But they're just offering their customers kind of a service where, yes, you could pay with Bitcoin, but that's only one half of the transaction. Um, we're not receiving Bitcoin a lot of times in these cases, if they're businesses that accept Bitcoin. And furthermore, we're really not pricing uh, the underlying um, unit that we're selling you in Bitcoin. It's really priced in pounds. We're just offering a real time exchange rate, in Bitcoin for you to use. So I think that's where probably Bitcoin has the hardest time kind of passing the money test. And I'm not aware of any business of any size or significance keeping their accounting records in Bitcoin for any period of time. If you are, I'd love to hear about it and how that experiment went. Um, Maybe there is one out there that tried to do this. But that's something you would expect to see too if Bitcoin was really serving as a unit of account. Um, and even on the medium exchange test, yes, there's in most countries, even many large towns, you can find places that will take Bitcoin. But a true medium exchange is something that you don't really have to think about when you receive it. You can turn around and spend it somewhere else because it is truly the coin of the realm in the place, physical and online, that you occupy. And Bitcoin kind of, might be usable in like a corner of the economy, right? Like a smaller sector of the economy. But it's not widely used enough as a media exchange, really, I think, to meet that test well. Certainly relative to other currencies, at least not at this point. But we've seen, El Salvador attempted to, for example, adopt it as official money, as a medium of exchange, and so on. It certainly is making progress in some people's eyes on meeting this money test. But today, most economists would not say Bitcoin really fully passes the monetary test. Like even a small currency, like in Iceland, I think it's the krona, tiny country, right? A few 100,000 people there. But in Iceland, you can receive that currency and know you can spend it anywhere, right? You see businesses keeping their accounting books in the Icelandic currency. You can go online, go in any shop. It really is passing that test fully in fulfilling these three functions in that economy in a way that Bitcoin just doesn't really anywhere, even in the crypto sector, so to speak. Okay. Um, Great. That's enough. Andreas, yes. I'm going to pause the presentation and go to questions if that sounds good. Is that what you wanted me to do?
Yes,
Oh,
exactly.
so yes.
Thank you. Yeah, great, great.
Yeah, good. So we'll stop sharing there. Um, And let's go to people who wrote questions in advance, which we always appreciate. Um, okay, so there's some questions here about Trust Wallet, and I want to avoid getting into specific products and talking about specific products and doing anything that risks appearing as an endorsement of a specific product. Um, you have to do your own research with any crypto wallet or exchange. Uh, you know, there's been a huge number of problems throughout the history of the crypto industry with different wallets suffering security breaches or people not understanding that a particular wallet is non-custodial, meaning uh, are responsible for your private cryptographic keys, your passwords, so to speak, that allow you to spend your crypto like Bitcoin. And there's no password reset or recovery mechanism for these private cryptographic keys, unlike an online platform like Instagram, where if you lose your password, you can get a new one and so on. That cryptographic private key, that string of alphanumeric string of characters, which is often represented as a seed phrase, a 12 or 24 word seed phrase, is something that is very, very precious, right? That if you are taking full responsibility for controlling your keys, as we say, and doing that with a seed phrase, keeping that safe, keeping that backed up appropriately, maybe keeping that offline. Again, not making any recommendations here. People do this different ways. They use hardware wallets. They use, even good old fashioned paper and pen, and ironically, will store that in a bank, trying to get away from using the banks with crypto, right? But still using the banks to store securely things like shards of private keys because you may not want to have the entire seed phrase in one place. You may cut it up. 12 words go in this safe deposit box. Another 12 words goes in another safe deposit box somewhere else, right? So there's no single point of failure, as we say. These are all different ways to, think about how you would store your keys. But I'm not going to comment on Trust Wallet or any particular wallet, and whether you should or should not use them. Um, some wallets. So I will answer this question, part two, David. Does that mean the wallet providers have access to your private keys? Certain wallets do. And so these are what we call hosted wallets, right? A hosted wallet, Coinbase being one of the most famous examples of this. Again, not an endorsement of Coinbase, but famously, the company I used to work for, blockchain.com, the founder there, Ben Reeves, and Brian Armstrong, this is a fun story you can read about in the Kings of Crypto, the early history of Coinbase, had a falling out on the night before going into Y Combinator, where they had a philosophical disagreement. Brian decided that he thought private key management, seed phrase management was too complex, um, too inconvenient, hard, so to speak, for everyday users of crypto. If this was going to grow beyond being nerd money and something that's just a geek or nerd toy, and so he wanted to have a hosted wallet platform where Coinbase would keep track of the private keys of its users, and you would have a password to Coinbase that could be reset if you lost that, and your crypto could still be recovered because Coinbase was taking on the responsibility of managing those private keys, whereas Ben Reeves and blockchain had a different view, felt that the real vision of Bitcoin and cryptocurrency and the freedom it offered entailed a responsibility to manage your private keys, and that was something that they wanted to get behind and build a product around. And so there's different points of view, I guess, on that. But yes, your question is correct. In a hosted wallet system like the one Coinbase also has an unhosted wallet where you are responsible for the private keys. But their main, most famous and I think successful product, their kind of brokerage account product, is a hosted account where they control private keys, and a lot of platforms do that. And in full honesty, I think Brian's philosophy and view of the way the world was going to play out probably was the more correct one, right? A lot of everyday users are just much more comfortable trusting their crypto private keys to a custodian, a platform that can manage them for them. But this is something that's not always well understood by users too, right? So I think a lot of users come to crypto and don't read the white paper. It's not the easiest paper for many people to digest and understand, but really they may not understand the whole private key hosted wallet kind of setup and what that entails. Um, yeah, technical question here about private keys and seed phrases and so on. So yeah, just I'm an economic historian, just to be clear. Not a cryptographer. Uh, I'm not going to try to answer the question cryptographically of how seed phrases are derived. Basically, a seed phrase can be kind of a master phrase for a wallet, I guess is the way to try to explain this. So you could have many private keys generated from a seed phrase. Um, a wallet can store a lot of Bitcoin addresses. Let's put it this way. Um, each address can have its own private key, right? A Bitcoin address is a hash of the public key. This gets into public private key pairings. It's a long, complicated topic beyond the scope of what we had time for here. Um, a great book, if you want to dig more into kind of the primitives of cryptography in a way that's very digestible. And you want some of the early history before Bitcoin on kind of the cypherpunks and um, people like David Chaum and others from the early days before Bitcoin is a book called Crypto by Steve Levy. Highly, highly recommend that book. Crypto by Steve Levy came out, I think, before Bitcoin was invented. Really covers nicely and explains very clearly public, private key cryptography infrastructure and all of this. So check that out. Um, Nico, it is clear that the cost of a 51% attack would be enormous, making it a purely theoretical scenario. It is probably impossible to quantify the exact cost of such an attack because they depend on too many factors. But is it at least possible to give a rough estimate of the approximate scale of the costs? Are there any reliable metrics that can be used as a basis for making an estimate? Um, so yes, there has been some work done on this. I, for a while, was on the review committee at the financial cryptography and data security conferences that often would take place in the Caribbean. Much to my delight, as someone who lived in the UK and hated UK winters, any chance to go in the winter to the Caribbean was appreciated. But it was a great conference for reviewing questions exactly like the one you're posing. In fact, I'm remembering papers that were published that actually would explore, well, what would it cost to rent enough hash power to attack different, blockchains or Bitcoin even. You could start to quantify and estimate based on hashing power, what the infrastructure, existing ASIC infrastructure, footprint looks like. There's signatures that different, machines, Antminers, S19s, et cetera, would offer. So you could even drill down to different classes of ASICs, right, that are mining Bitcoin to again get a kind of financial value around how much equipment is currently securing the network. And there's been other work. We did some work at the University of Cambridge, and it's been continued elsewhere, looking at where that equipment resides, um, and thinking about mining pools in particular as vulnerable, um, players for harnessing a successful 51% attack against even Bitcoin, right? And at various points in time, some mining pools have come close or exceeded even 50% of the hash power that happened as far as early as I think 2015, 2016. It was a ghash.io. I'm forgetting the name. There was a lot of concern at that time about them having 50% or more of the, and I may be getting the name wrong. So forgive me if I'm getting the name wrong here, but about them having over 50% of the network. That was kind of a well understood fact, and people were concerned about a single entity mining or controlling that much hash power. So yes, there might even be websites out there that have attempted to, on a real time basis, estimate what kind of financial cost would be involved with the 51% attack. I think the other thing I would say about a 51% attack is that, a lot of people worry about nation state actors, as kind of the most likely folks to carry out such an attack. And this gets into quantum computing, the quantum, D-Day scenarios, quantum risks to Bitcoin as well, whether a nation state might attack something like Bitcoin with quantum computer that could crack Bitcoin's cryptography. The thing to remember about nation states is that they don't always have direct financial incentives for why they do things, right? It may be financially really expensive, and there may not be a net present value um, that can be, gained by a nation state by doing something like attacking Bitcoin. But nation states are not firms. They don't have shareholders in the same way a company does, or they don't go broke in the same way you and I can, right? Um, so they may do things that don't make a lot of financial sense for other reasons. And that's something to kind of keep in mind as you think about how likely something is to be attacked. I mean, the other thing I always like to think about on this question of would Bitcoin ever be successfully 51% attacked is I think back to George Lee Mallory, who was one of the first, to really try to climb Mount Everest in the 1920s. He was asked, "Why do you do this, George?" And he responded famously, "Because it is there. That's why I try to climb Mount Everest." And I guarantee there are many a hacker out there who would love to take down Bitcoin simply because it is there, because it hasn't been done yet, right? And just to go after it for that reason. So it may not be a purely financial reason that someone tries to attack Bitcoin either via a 51% attack by getting in control of significant enough hash power you don't even need 51% to wreak havoc, right? As we have seen demonstrated in papers like the selfish mining papers and so on, that literature, but also a quantum attack as well may not be financially motivated. Although I have a feeling if nation states, just on the subject of quantum, do have a quantum breakthrough, there's going to be much, much higher priorities than attacking Bitcoin. Um, that's probably pretty far down the list of things a nation state would want to do with a quantum computer that can crack, for example, sensitive communication encryption. Okay, let's keep going here. Okay, Charwell, how is AI and quantum computing affected cryptocurrency development? All right. Well, I anticipated the quantum question. I had a feeling there'd be some quantum questions. It is a hot topic today. A lot of people think that Bitcoin's price can't really rally to a new all-time high until this quantum question is settled. I don't know about that. I think that's an interesting point. AI, though, I think there is a lot we can say about that. I think AI is, of course, the new thing. It's very hot in Silicon Valley here and elsewhere. It's drawing in huge resources. We've seen mining, players, Crusoe, right, which was focused on Bitcoin mining using flared gas, really pivot to AI data centers and infrastructure, making way more on that than they did with Bitcoin mining. So it is having an impact. I think a lot of bright people when they're thinking about like young people where to go, what career path to choose, are looking at the world today and thinking that AI looks more exciting, potentially more lucrative than crypto. I think one thing that's really weighing on the crypto space is for many years, there was a real openness and support and investment behind supporting new layer one blockchains or, side chains or dApps and different experimentation. And that whole quadrant of crypto is really in the dumps. I think there's a real rethinking going on about how many layer one blockchains are necessary, whether the level of investment we've seen in the past for all this experimentation, as interesting as it was, as promising as it may have seemed, really can be justified from a return on investment perspective. So if VCs are pulling back and other investors in supporting this broad crypto ecosystem with lots of decentralized finance applications and blockchains and so on, you could see kind of the space suffer, right, from less funding, less support than it has historically. Um, and that's both an internal kind of intrinsic thing going on in crypto, right, as well as something that's informed by what's happening in other kind of frontier, exciting, um, bleeding edge sectors of technology, space, right? eVTOLs, quantum, biochemistry, AI, et cetera, right? All these other things that people are thinking about, um, in many minds look like the next place to make 1,000x, right? Not crypto. Crypto for a while looked like the place you would go if you wanted to just purely from a financial returns perspective make 100x, 1,000x potentially on the next DApp, layer one blockchain, et cetera. And now people aren't as sure, and that means investment has, there's more competition for those investment dollars. Um, so those are a few thoughts on AI and quantum, and then in terms of how AI and Bitcoin and crypto could evolve together, I think that's a really interesting topic. A lot we could try to dig into there. I mean, just one thing I'll say on that is we imagine the machine economy evolving, and we get to a world maybe where machines are transacting more with machines, some kind of programmable currency that plays well and is digitally native and so on with that kind of AI machine to machine economy could be a really strong fit, right? And so I think that's one scenario where we could see, crypto maybe taking off more for currency. We're not there yet, but I'd keep an eye on that. And there's, of course, other use cases like what is real? Can we use blockchains to help us digitally authenticate, what's AI slop versus, something real? Um, those are interesting, I think, use cases too that people are still trying to explore and figure out. Um, Spam prevention. Yep, exactly. Okay, Kevin, where do the mathematical equations for the proof of work for each transaction come from? Seeing as there is no central computer or individual or seeing the system, I assume a large numbers of these equations go out every minute or at least every hour. There's a randomness dimension to exactly the difficulty measure. Like, so basically, you have some number of computers, hash power, right? Guessing at what the nonce is, and this gets into the technical weeds a little bit, to solve kind of the puzzle, the crypto puzzle that the blockchain generates to earn the new bitcoins and earn the transaction fees for a given block, right? And the difficulty measurement is looking at the hash power and resetting that every 2 weeks, roughly, to make sure that those guesses at the nonce value are only solved after a 10-minute period. So there's a recalibration that goes on, and there's a randomness built into this that I'm not the best person to try to explain all of that, and certainly can't do it very concisely if I even tried. So I'll leave it at that. But that gets into kind of deeper cryptography questions that are beyond the scope of what I'm trying to cover here in this lecture. But it's a good question. And if it wasn't random, and there have been wallet infrastructure companies, including one I used to work at, that did not have sufficient randomness in their random private key number generator. Um, in that case, this is like 2014, 2015, a white hat hacker informed blockchain.info, which is what the company was known at that time, that they had not had a sufficiently random number generator employed in their wallet infrastructure. You can successfully guess at the private keys for wallets and steal bitcoins. So very important topic, right? And one that some of the even leading companies in the space have messed up on at times. Um, okay, Mandy, how can we tell which block has the greatest cumulative difficulty total proof of work used to create it? What relevant data is available on chain? And can you share if there are real life examples where smaller and less decentralized networks were attacked successfully? Yes. So on starting with point two, Bitcoin Gold, there were a lot of like Bitcoin clones, and have been hundreds, if not thousands. Some of them actually achieved, decent market caps. And, I think Bitcoin Gold was a top 30 crypto asset back in the day. This is like 2018, 2019, around that time frame when we were seeing a lot of Bitcoin forks. We saw Bitcoin Cash, of course, emerge around that time frame, BSV, etc. Bitcoin Gold, if my memory is correct here, was successfully attacked through a 51% attack. And the way this attack was executed is a kind of smart way to do it. Um, so basically, again, Bitcoin Gold wasn't worthless. It was worth something. It was traded on exchanges. You could deposit it, exchange it, and so on and so forth. Someone deposited, I believe, some Bitcoin Gold onto an exchange. All right. They converted that Bitcoin Gold into Bitcoin, BTC, withdrew the Bitcoin, and then they did a chain reversal where that deposit of Bitcoin Gold into the exchange never occurred, right? They produced, the attacker did, we think, a longer chain with more proof of work, more computing, hashing power, and guesses behind the blocks than the one that showed the deposit into the exchange. So basically, they had enough computing power to run a simultaneous kind of like parallel blockchain, if you will, that was, solving blocks quicker than the chain where the deposit was made on. And when they revealed, they published, they propagated that chain, um, across the network, all the nodes and the, network participants pointed to the new longer chain. That's the rules of the game in proof of work, right? And so this shorter chain with less accumulated computing hashing power behind it was discarded. It was orphaned, right? Um, and if you want to read more on this, you can read. I referenced this earlier. Selfish mining attacks are kind of an interesting example of this, where um, miners will, you know, solve a block but not reveal to the community they've solved it, and so they can begin working on the next puzzle while everyone else is still working on the older puzzle and wasting their resources working on a shorter chain that's going to be orphaned once the selfish miner reveals their longer chain with more solutions in you know to the network that then everyone has to adopt per the rules of the protocol. um, so yeah, really interesting tactical game theory issues around all of that. Yeah, there's some really good technical questions coming in, um, that yeah, I want to be careful I don't try to try to answer like this. Wilson, your question I'm gonna punt on, honestly, because you're asking about basically alternatives to how we approach solving the Byzantine generals problem, um, from kind of Nakamoto consensus and proof of work with a blockchain. Good question. I'm going to punt. Not sure how best to answer that. Would want to do more research on that before I attempted that. Well, Michael, I think on your question, the longest chain is not an invalid one. Basically, one of the beautiful things about, the blockchain and proof of work is it's very, very quick and easy for nodes to validate that it's correct, right? It has a valid solution to the crypto puzzle, uh, and digital signatures and so on and so forth. Very, very hard, takes 10 minutes for the Bitcoin network to solve the crypto puzzle, right? But kind of like a Sudoku puzzle, which can take 10 minutes, it takes you a second, or two to quickly scan a Sudoku puzzle and see that the solution is correct, right? So validating a correct, you know, proper blockchain is something that nodes can do very, very easily and quickly. Um, just by checking the the publicly available information. One, quantum computing is a risk for Bitcoin. Can blockchain technology use quantum computers to enhance its cryptography? The cryptography actually used cannot be changed. Well, so I'm not a quantum cryptographer, right? Here's what I can say though, having talked to a lot of quantum experts about Bitcoin, the security issues, and so on. So first, parts of Bitcoin are already quantum resistant. Not everything has to be changed for Bitcoin to remain quantum resistant. So that's the first point. The second point that I think it's important to make here is that, you know, the world, not just crypto, not just Bitcoin, really depends on cryptography. Our financial system, government communication, many, many things beyond crypto wouldn't exist reliably without reliable cryptography that's secure. And so there's obviously huge incentives for different actors, nation states in particular, perhaps working with, private sector labs, in conjunction with the private sector to invest in quantum computing that can successfully crack, you know, um, using things like Shor's algorithm, which was developed a long time ago, that can crack some of Bitcoin's cryptography, use those algorithms to actually, see private military communications like happened in World War II with the Enigma machines. The Germans, machine for communication was cracked, right? Huge value there. But there's also a huge incentive for players to continue to invest in quantum resistance, right? And so just from a purely economic perspective, which is how, I think about this as a non-cryptographer, I think the balance of incentives is on the defensive, continue to develop quantum resistant cryptography. There's just more players and more resources, I think, supporting that than probably the attackers. I can't prove that assertion to you. This is more of what my gut tells me. Um, but our world just simply would not function well if we didn't have cryptography. So it's kind of like we have to have it, right? Things will come to a screeching halt. The financial system, et cetera, if there is no way to protect, you know, um, digital information, transactions, et cetera, from a quantum attack. And some of what's out there already is quantum resistant. Quantum computers don't do everything better than classical computing. They do certain things better, um, like factoring prime numbers and these kinds of things that are important to, cryptography. So there are solutions. The bottom line is, I think there are solutions out there to this quantum risk, from what I can tell from talking with quantum experts. The politics is trickier. It's like, well, what do we do with Satoshi's coins, which have never moved? That's like one of the big debates in Bitcoin is some of those coins might be more exposed and at risk via a quantum attack. Should that be kind of like a bug bounty that an attacker can claim who successfully invents a powerful enough quantum computer to actually crack the private keys of Satoshi's coins? Should those coins be burned? Should they be recycled, and kind of reissued to new mining, players, down the road? I mean, the politics is what's making this complicated. On top of the fact that yes, there are some innovations needed in quantum resistance, but not there's stuff out there already that could be substituted in that people think is quantum resistant. The thing is, with cryptography, there aren't mathematical proofs that something's secure. That's the challenge here. It's not like it's a mathematical equation. 1 + 1 = 2. You can prove that. You only know something is secure when it hasn't been successfully attacked, right? So we think some things might be quantum resistant, but the way to know that is over time. This cryptography is securing this amount of value, and it hasn't been successfully cracked, and it's a big number, a lot of value. You can grow more confident that it is secure to an attacker, but you can't know or prove for sure that it is. That's one of the tricky, frustrating things about cryptography and security. All right. Good questions. Very impressed with the quality of the questions. Um, how are we doing on time here? Got a few more minutes. I want to take a few questions that have come um, in the comments as well. Let me just quickly scan through the early questions. Could Bitcoin change from proof of work to proof of stake as Ethereum did? Look, it's just code. If consensus changes in the community, the social consensus around what's appropriate, sure, why not? You could see even something like the 21 million limit get changed if the security um, that new coins and transaction fees are not keeping up with attacks in terms of incentivizing a big enough security budget and amount of hash power to secure the network. I think that's going to be a legitimate topic for debate. That may be sacrilege. I think many people rightfully see that 21 million coin limit as something inviolable that is really the essence of Bitcoin or one of the cores of what Bitcoin is. But if that limit becomes so costly that the chain is insecure and risks failure, I mean, it would be a legitimate debate topic, I think, at least. Whether it should happen or not, is another story. But um, the whole reason we're talking about Bitcoin and cryptocurrency or crypto assets is because these blockchains are secure. That is the foundational bedrock, the substrate on which all this exists. And if there is unreliability around the security, uncertainty around trusting who owns what, none of this is worth anything. It goes to zero. So everything is fair game for discussion if the core foundational security is at risk in any way, shape, or form, including, you know, taboo topics like should Bitcoin's limit of 21 million coins be changed at some point? That's not a settled question. We don't know for sure that the economics of the 21 million limit are going to play out, well in the years and decades to come. Having a rising price has really helped continue to keep a large group of miners and hashing power securing the network. That does seem to so far have been impossible for an attacker to basically figure out a way to attack. But, what if the price drifts downward or stays even steady as the reward declines? Well, then the security budget goes down lower and lower. Do you see companies like Coinbase and other large players coming in and subsidizing Bitcoin security in the same way they often would subsidize, supporting a core developer, which was done. A lot of companies would sponsor core Bitcoin developers, as kind of a good citizen effort. We're going to see that like good citizen mining to support the chain. There's different ways to kind of counteract a declining security budget. But these are all, you know, important questions and unsettled questions, for sure. But I think one thing that's gone away that drove that question, Gregory, is the concerns about the environmental impact of Bitcoin's mining, the amount of energy consumption. I almost never hear anybody talking about these days because AI energy consumption is so outpaced what Bitcoin is doing now. It looks like a drop in the bucket, right? In terms of the size of the data centers and so on and so forth. So um, maybe that issue has been put to bed permanently with the rise of AI electricity consumption, which is just off the charts compared to what Bitcoin is doing. Um, okay, what else here? Can blockchain transactions be distinguished by type, or do they all look the same on the ledger, Gabriella? Yeah, just real quick, there are certainly different types of transactions. There's different transaction formats, older formats, more modern ones that use, seg witness. There's of course multi-signature transactions. Um, different scripts and things. So there are different types of transactions. They don't always look the same, although some can be formatted the same, go to the same type of address, and so on and so forth. So you have classes of transactions that certainly can look the same in essence. I mean, no transaction is the same, but they may use the same format, same address types and so on and so forth, not have, any kind of multi-sig or time lock or any of that nature, in the script. But there are different classes of transactions that are different. Um, and yeah, also like transactions amounts, time of day. Now we're getting into the kind of the heuristics of chain analytics. And what chain analytics companies will do is look at, like round number amounts or certain characteristics of a transaction to kind of infer or guess at the nature of the transaction, who's transacting, and so on and so forth. And then some addresses, of course, are known as to belong to a certain company, and that can help kind of unmask identities behind a transaction. You can look at the history of the transaction too, where the Bitcoin has been transacted previously, how it's been transacted to, again, kind of guess using heuristics at what a transaction may represent, who may be behind it, and so on and so forth. Gabriella, again, I believe, how will AML and compliance rules evolve in Web3 in the crypto industry? Well, this is a political question, right? A regulatory question. And there's a lot of debate about this. I mean, my general philosophy on the whole privacy topic, and we talked about the cypherpunks and their philosophy, is that in society there's a tension between those who want more privacy and those who want, more information and access to what's going on, law enforcement, for example. And that political battle will kind of ebb and flow based on what's happening in a given society. When you see maybe companies or the authorities abusing um, their access to information, you may see political actors push back and demand greater privacy, right? And so for a time, maybe the privacy crowd is winning and getting more privacy protection. But then you may see something bad happen. You may see a terrorist attack or something horribly, with children or something go wrong, and the advocates for greater transparency and insight into the lives of citizens, companies, etc., may win the day, and you may see pushback. So I think that's a never-ending battle. I don't know that that's ever going to be solved. It's one of the more interesting policy areas for sure in the whole cryptography, crypto, digital, space. For people looking for career advice, I mean, I think technology policy is a very interesting arena to consider because of these never-ending debates about how much privacy is the right amount of privacy. I don't think that's ever going to go away, and will really, I think, be influenced by events and what happens and the public outrage on either side of that debate that we see. Okay, I think we've got maybe just a couple of minutes now. Um, uh, Let me look through some of the questions in the comments here just to see if there's anything, because I appreciate everybody um, chiming in here. There is a stablecoin question. I do think it's worth just briefly, and there'll be a session later in the course on stablecoins. Um, Stablecoins have been an area that I've spent a lot of time doing research, and I've even worked on some stablecoin projects. These are cryptocurrencies that are programmable, usable with crypto wallets, and so on and so forth, that often are linked to, today at least, the US dollar. There are other ones like the euro backed Monerium crypto project. My friends from Iceland, who I've done some work with, are behind that project. But the dollar really dominates the cryptocurrency landscape today, especially Tether, one of the oldest, founded in 2014, over a decade old, and most profitable enterprises per employee in history, making billions in interest income. Stablecoins have really supplanted, in many ways, Bitcoin's role as kind of the primary, kind of currency pair in the exchange trading world. A lot of payments across platforms are now conducted with stablecoins, and it's, I think, a big part of why we've seen the term cryptocurrency when we talk about Bitcoin fall out of favor is the rise of stablecoins being much more actively traded than Bitcoin, more commonly used as a trading pair, and now we have legislation in jurisdictions like the U.S. which are kind of like setting the stage for stablecoins to cross over into mainstream commerce. Um, uh, and your question, though, Catherine, was about governments issuing stablecoins. I don't know that that's happening so much. There's talk of central bank digital currencies. That's stalled. I mean, there's an active project around a digital euro, and there's some things that have happened there. But stablecoins are really private sector creations by companies like Circle, Tether, and others. Um, but it raises a good question around, well, what does it mean for kind of the future of payments in crypto? Um, and that's something to keep an eye on, right? It gets back to this question of store of value and how stable it should be. The reason stablecoins have been so successful in large part is because of how volatile Bitcoin and other crypto assets have been. And when you're looking for like a safe haven or a shelter from the volatility storm, it often works a lot better to move into a fiat currency like the dollar. People will correctly point out that over decades, the US dollar is losing its purchasing power, down 80, 90% in the last 50 plus years. But its volatility day to day, month to month is dramatically less than Bitcoin's. It's true. The dollar or other fiat currencies can drop double-digit percentage points in a given year. I think the Russian ruble may have dropped almost in half at various times in the last few decades. But that's happened maybe once or twice, or in extreme cases like the Argentinian peso, you might see even more frequent drops. But there's been a dozen plus times, I don't have the chart in front of me, where Bitcoin's dropped 40, 50%. Multiple times it's dropped 80%. Multiple times it's even dropped 90% in a given 12-month period. So we've never seen an asset as volatile as Bitcoin in history. And that really undermines the kind of reliability from a store value perspective for using this as a regular means of payment, or trying to keep your books, your accounting records in something that volatile. And it's really opened the door for things like stablecoins. So that's a huge kind of outstanding question. Will we have one day where crypto assets are less volatile? And what would that mean for their use beyond being speculative investment vehicles, or digital commodities? Could this become a currency and really compete more head on with fiat currencies? So I think that's probably, Andreas, a good place to stop. That sets up nicely, I think, my next lecture later in the course on the geopolitics of cryptocurrency, where we will return to this discussion of the future of money, and whether Bitcoin, stablecoin, central bank digital currency, or something maybe one of you will invent someday, could play a role on the global stage. But I'll stop there. It's been a pleasure. Thank you for the great questions. I'm sorry I didn't get to all of them. Sorry, some of the more technical ones are really beyond my pay grade, but appreciate your questions, and thank you for joining. Have a great rest of your day and week.